Hello and welcome to our online classes. In this video, I will attempt to explain to you the concept of initial public offering. I will try and explain to you the process of an IPO and the steps that any company which wishes to raise capital via the IPO needs to take. Okay? Now, what is an IPO? Well, an IPO or an initial public offering is a process where a company issues shares to the public for the first time. Okay? What does it mean by issuing shares? Well, it simply means that the company is selling ownership or sharing the ownership with the public or investors at large. The public or investors buy this ownership, and in this way, the company gets to raise capital. Well, this IPO is often done by smaller or younger companies seeking to raise capital to expand. Okay, so for example, if you have a company and if you have a few factories and if your business is doing well, and you want to set up a few more factories, you would definitely need capital. Where would you get this capital? Well, suppose you already have taken in a lot of loans from the bank and you don't want to take any more loans. That means you don't want to add to your debt. What you can do is you can sell part ownership of your company to the public at large. The public will buy ownership or buy the shares and you will get the capital. With this capital, you can set up the extra factories that you wanted to. So this is why smaller companies or younger companies will look to do an IPO to raise capital. A follow-on offering is similar to an IPO, but in this case, it is an issuance of stocks, subsequent to the initial public offering. That means a follow-on offering is like doing an IPO the second or the third or the fourth time. In this case, it's not an initial public offering, but a follow-on public offering. That means raising capital by issuing fresh shares after the IPO has already been done. Now the question is, why would companies do an IPO? Well, of course, I've answered part of the question here because they want to raise capital, but there are other reasons why a company would do an IPO. Firstly, of course, what I have said, to raise funds for financing capital expenditure like expansion or diversification. That means a company wants to grow its business, set up new factories, diversify into other sectors. They'll need capital. They can do an IPO to raise the capital. Another reason could be to finance increased working capital needs. Working capital is the amount of capital that each company needs to have to continue its operations day to day. Okay, so that's called the working capital. Sometimes it might happen that the working capital requirements of a company has gone up. Okay, so the amount of money that the company needs to keep with itself to keep its day-to-day operations ongoing has gone up. So the company will need more capital. Where do they get this capital from? Do an IPO, sell ownership of shares, sell new shares to the public and raise capital. Another reason is debt repayment. Well, what is debt repayment? Some companies, in the initial stages, take in a lot of debt. That means they borrow a lot of money to expand their businesses. Later on, when their businesses are doing well, they look to reduce the debt that they have. They look to pay back the debt. How would they do that? Well, one way to do it is they sell ownership or they do an IPO where they issue shares to the public, they get the capital, and a part of the capital is used to repay the debt. What is the advantage of repaying the debt? Well, whenever one takes a loan or debt, a company needs to pay monthly interest, okay, or quarterly interest. That interest is going to come down if the amount of debt comes down. So that's a good way to reduce the costs a company faces by reducing the debt. Okay. Another example is an exit route for existing investors. Well, what does this mean? Well, it means that when a new company starts, it rarely happens that the new company issues shares to the public and raises capital. A new company always starts with capital from the promoters. or with capital from private equity investors or venture capitalists. Uh, Private equity investors or venture capitalists are a group of companies which provide capital to startup firms or firms which have just started their business and their business model looks promising. Okay, so when these investors, these initial investors who put in money into a completely new business model, they would want at a later stage a possibility to exit their investments. How can they do that? Well, the best way, a possible way to do it is that the company issues shares, raises capital, and this capital is used to pay back the existing investors. So the existing investors sell their holdings to the company, and the company pays those investors with the capital raised from the IPO. So it's an exit route for existing investors. Another reason is to gain the benefit of getting listed on the stock exchange. Whenever a company is listed on the stock exchange and its shares are readily traded, there are some benefits that the company gets in future capital raising issues. Okay, we will talk about these in future videos when we talk about corporate actions. But for now, it would suffice for you to know that there are some benefits of a company getting listed in the stock market. Okay. Now, listing provides liquidity to existing shareholders. This point is very similar to the exit route point. It provides existing shareholders a way to sell their ownership to the public or at the secondary market if they wish to do so. Okay, so it provides existing shareholders a possible exit route. So their investments, the investments of the existing shareholders, become liquid. Why? Because they now have the option of selling their shares in the share market. Finally, it establishes the value of the firm, and it gives prestige and prestige and exposure to the public, because whenever a company is trading in the stock markets, whenever the shares of a company are trading in the stock market, the company acquires a certain prestige because it's a publicly traded company. Okay, and the value of the shares that are trading is also a good way to understand what is exactly the value of the company. So these are the reasons why companies do IPOs and the benefits of doing IPOs. But there are certain disadvantages of doing IPOs as well. Well, what are they? Firstly, IPOs are very expensive. To do an IPO, there are significant legal costs, there are accounting costs, there's a marketing cost. So all these costs make raising capital via IPOs very expensive. Secondly, any company which is public, which has its shares trading in the stock market, is mandatorily required to disclose financial information every quarter in a year. Okay, so there is a requirement for a public company to release its financial statements every 3 months. So there is a cost related to this as well. So this is a disadvantage for a company going public and issuing and having its shares trading in the stock market. Thirdly, the senior management needs to, whenever a company wants to do an IPO, the senior management do get very involved in this process, because this process is a very important and a very crucial and a complex process. Okay. Now, if the senior management spend most of the time in thinking and working about the IPO, then this is in a way harmful to the productivity of the company, because the senior management should be working for the productivity and the growth of the company, and not a process like the IPO. Okay, so it diverts the attention of the senior management into doing something which is not really benefiting the company directly. Okay. Thirdly, next point is that the information about the company will now have to be made public. So this gives competitors, a useful. This gives competitors a way to get to know about the company and get to understand about the financial situation of the company. Because any company which does an IPO and goes public and has its shares trading in the stock market will have to release its financial statements every 3 months. This allows competitors to get to know more about the company. Last point is, from an investor's perspective, valuation of an IPO is very difficult, because whenever a company is coming and issuing new shares to the public shareholders, what should be the price of that share? That's a question which investors need to try and understand. Why? Because this company is a completely new company. Its shares have never traded in the market. Excuse me. It is coming and issuing new shares. So what exactly is the value of these shares? Okay. Now the company does provide financial statements before it does an IPO, but those financial statements might not be enough to understand what is exactly the value of an IPO. So from the perspective of the investors, this is a disadvantage, because valuation of the IPO is uncertain in some way. Now let us try and understand the process of an IPO. Okay, what does a company which wants to raise capital via an IPO process needs to do? Well, the first thing that they need to do is they have to nominate a merchant banker or a consortium of investment bankers who will help them in this process, and one of them is assigned is known as the book running lead manager. That means one of the investment bankers takes the lead role, kind of like the captain of the team, and this investment banker becomes the book running lead manager, or BRLM. The next process is the BRLM, or the book running lead manager, prepares a draft prospectus known as the draft red herring prospectus and submits it to SEBI. SEBI is the market regulator in our country, and this process is called IPO filing. So whenever you hear about IPO filing in news channels and newspapers, it's nothing but the BRLM filing the draft red herring prospectus with SEBI. Okay. The company also hires an authorized IPO grading agency. Okay. Now, when I was talking about the disadvantages of an IPO, I said that it is very difficult to value an IPO from an investor's perspective. Hence, SEBI, or the market regulators, have made it mandatory for companies wishing to do IPO to get their IPO graded. An IPO grade is like a score telling how good the company fundamentals are, or how good the company's business is. Okay. Now, so an IPO grading agency is chosen to grade the IPO. Okay. Who are these grading agencies? Well, CRISIL, ICRA, they are all the grading agencies. Next, after receiving SEBI clearance, when SEBI reads the draft red herring prospectus and approves the IPO, the application forms are distributed for investors to participate in the IPO. So any investor who wishes to participate in the IPO fills up this application form. After which, the issue becomes open to the public. Now, what does it mean, the issue becoming open to the public? Well, it means that if the IPO is a book building process, well, I will explain what a book building process is just in this video, but it's a process in which the price of the IPO is actually determined. Okay, an IPO can either be a fixed price IPO or a book building IPO. In a fixed price IPO, the price of the IPO is predetermined. In a book building IPO, investors bid for the number of shares they want and the price in which they want the shares, and the book running lead manager collects all these bids and arrives at a fair cutoff price at which the IPO is launched. Okay, this process is called a book building process. Next, the IPO is closed, and if it's a book building process, the issue price is determined by the lead manager. Then, once the price has been determined and the demand from the investors have been taken into consideration, the registrar distributes the shares as and when requested by the investors. Okay, so the policy to distribute is a fair distribution policy where any investor gets the number of shares in proportion to how many he had bid. Okay. Finally, the IPO is deposited into the dematerialized account or the demat account of the investors, and the date is set on which the IPO or the share will get listed on the stock exchange. Okay, it is on this date that the stock or the shares of this particular company will start trading in the stock market. So this is the end-to-end process of an IPO. This is what a company needs to do to raise capital via an IPO. Now, I just said I would explain to you what is a book building process. Well, a book building process is a price discovery mechanism. That means, as I have just said, that discovering a value, finding the value of an IPO is very difficult. So, investment bankers have come up with a way in which they don't exactly fix the price of an IPO at which investors need to buy those shares, but they provide investors with a range. Okay, investors bid for the number of shares that they want within this range. And investment bankers, looking at the bids that have come in and the prices at which the bids have come in, determine the price at which the IPO needs to be launched, or the offer price, or the issue price. Okay. This process aims at tapping both wholesale and retail investors. Okay, because for retail investors, it is very risky to take part in an IPO which is fixed, where the price is absolutely fixed. If the price is not fixed and rather a book building process is followed, retail investors have a choice. They have a range within which they can bid for the number of shares that they want. Okay. Now let me explain to you what exactly is a book building process with a small example. Well, let us take a company which wants to issue around 10 lakh shares. Okay, and the price band it gives to raise these shares is 60 to 85. So investors can come and bid for the number of shares that they want within this range, 60 to 85. Now let's take a look. Let's assume that the bids that have come in at these prices. So, for example, at the price of 85, bids have come in total amounting to 2,50,000 shares. That means a total of 2,50,000 shares have been bid at the price of 85. Around 3 lakh shares have been bid at the price of 80. 4,50,000 shares have been bid at the price of 75, and so on and so forth, 70, 65, and 60. So what will be the issue price for this IPO? Well, we will take a look at the cumulative bids and arrive at the point where this IPO, where the total cumulative bid is more or less greater than equal to the number of allotted shares. So we see that at the price of 75, the total cumulative bid is equal to the total number of shares. That means it is at this point, it is at this price, all the demands for the shares are being satisfied. Okay, all the demands for the shares are being satisfied. Hence, 75 becomes the issue price. This is a book building process. Okay, this is what happens when a book building process is launched by a book running lead manager to issue new shares of a company. I hope this process has become clear to you. I will explain to you some more terms about IPO in my next video. Till then, goodbye.